The most dangerous place to put your money right now, a traditional savings account. I know that sounds crazy. Most people think keeping wealth in cash is responsible, but after years in investment banking, I learned something most people never get taught. Cash isn't risk-free. It's just a different type of risk. And today, I'm going to show you why some investors treat Bitcoin not as speculation, but as insurance. I'm the NYC banker. Let's audit the numbers. When most people think about risk, they think about losing money. Stocks can crash, crypto can crash, real estate can crash. Cash feels safe, but there's another risk most people ignore: purchasing power. 10 years ago, $100 bought more groceries, rent, travel, and services than it does today. Your bank balance may stay the same, but what that money can buy keeps shrinking. That's inflation. And from a balance sheet perspective, inflation is one of the most effective ways debt-heavy economies reduce their burden over time. This isn't a conspiracy, it's basic economics. The risk isn't that your cash disappears. The risk is that its value slowly erodes. This is where Bitcoin enters the conversation, not as a lottery ticket, not as a get-rich-quick scheme, as an asset. Bitcoin has a fixed supply. Only 21 million will ever exist. Unlike traditional currencies, no central bank can create more of it. Now, that doesn't mean Bitcoin is safe. It's volatile, it's speculative, and it can fall 50% faster than most traditional assets. But serious investors ask a different question. Does this asset behave differently from the rest of my portfolio? Can it provide protection if traditional monetary systems face pressure? That's the investment thesis. As a banker, I don't gamble. I allocate. Some investors treat Bitcoin like gold, not as their entire portfolio, not even as a large position, but as a small piece of a diversified strategy. Think 1 to 5%. If Bitcoin fails, the portfolio survives. If it succeeds as digital gold, that small allocation can have a meaningful impact over time. That's not speculation. That's risk management. The biggest lesson Wall Street taught me is this: the smartest investors don't focus on returns first. They focus on preserving purchasing power. Cash has risks, stocks have risks, real estate has risks, Bitcoin has risks. The question isn't which asset is perfect. The question is whether you understand the risks you're taking. I'm the NYC banker. If you want to understand how money actually moves beneath the surface, subscribe and follow along.